As of the close of trading on July 29, 2026, Qualcomm Incorporated traded at $155.57, dropping $7.31 or 4.49% during regular market hours, before sliding further in late post-market action, down toward $144.53. The stock market is currently closed, but the immediate catalyst behind this violent downward move centers on the company's freshly released fiscal third-quarter financial results. While headline revenue came in at a respectable $9.9 billion, beating top-line targets, non-GAAP earnings landed at $2.21 per share, missing consensus estimates by 2 cents. On the surface, missing earnings by 2 pennies doesn't look like a catastrophe that justifies a double-digit drop. The real tension cutting through the market is that investors are fixated on the traditional smartphone cycle, where a sharp projected drop in Apple-related revenue and temporary gross margin compression are causing mass panic. Yet right beneath the surface of this smartphone drama, an entirely different financial story is quietly taking shape. While mainstream traders panic sell Qualcomm stock based on legacy handset fears, institutional capital is closely tracking Qualcomm's rapid expansion into automotive silicon and artificial intelligence data centers, where non-handset chip revenues surged 28% year over year. The broader market narrative surrounding Qualcomm stock has long been anchored to a single belief, that this is primarily a cellular modem and smartphone processor play, bound to suffer as giant tech customers build in-house hardware. That expectation is why every time Apple or Chinese original equipment manufacturers show inventory hiccups, retail investors throw in the towel. But the reality unfolding inside the company's balance sheet tells a far more complicated story. Wall Street expected a pure mobile decline, but management simultaneously revised its long-term non-handset revenue target up to an eye-watering $40 billion by fiscal 2029. This creates a massive gap between what short-term momentum traders are reacting to and what long-term capital allocation models are pricing in. If you look at options order flow, retail traders using a typical individual brokerage or retail trading setup on the Robinhood app are dumping shares in response to the headline miss, while institutional money management desks utilizing Interactive Brokers routing and institutional Fidelity trading platform feeds are absorbing volume near long-term support levels. Trading volume surged dramatically during the decline, with over 14.5 million shares changing hands during the standard session before extended trading accelerated the sell-off. The intraday technical setup showed total breakdown beneath key moving averages. Leading into the print, Qualcomm stock had been oscillating between its 50-period moving average of $171.01 and its 200-period moving average near $168.08. The break below $165 triggered automated stop-loss cascades, pushing the share price right toward multi-month technical floors. Macroeconomic factors have undoubtedly added fuel to this fire. Rising semiconductor supply chain expenses, fluctuating wafer manufacturing costs, and broader risk-off sentiment across tech indices like the NASDAQ have placed intense pressure on rich semiconductor valuations. When macro headwinds combined with a minor earnings miss, the market tends to shoot first and ask questions later. Yet the underlying operational metrics reveal that while gross margins face temporary pressure, expected to sit slightly under the historical 48 to 50% band, Qualcomm is already pushing through double-digit price increases across major component lines to restore structural profitability over the coming quarters. This exact dynamic is where retail sentiment diverges from reality. Ask yourself this question and share your perspective. Comment below how many shares of Qualcomm stock you currently hold or plan to buy during this market dip. Watching how retail accounts react on popular self-investing outlets gives a clear window into sentiment shifts. When users managing an online investment portfolio across platforms like SoFi Invest or Schwab Intelligent Portfolios see a solid 4 to 7% red day on their screen, the emotional reaction is almost always to cut losses. But evaluating chip makers requires looking past single-quarter headline noise. In fiscal Q3, Qualcomm's automotive business delivered a record $1.6 billion in revenue, representing a massive 61% year-over-year expansion. Furthermore, management raised its annualized automotive revenue exit run rate for fiscal 2026 to $7 billion, up from $6 billion. They also announced major compute silicon partnerships, including serving as lead provider for BMW Group's digital cockpits and automated driving platforms. While commentators obsess over smartphone volume fluctuations, Qualcomm is quietly locking in multi-year automotive supply contracts that provide predictable, high-margin licensing and product revenue for the next decade. To truly understand how Qualcomm built this massive dual revenue structure, we have to look back at how the underlying business model operates. Founded back in 1985 in San Diego, California, Qualcomm Incorporated established its foundation by pioneering code division multiple access technology, better known as CDMA. That foundational research formed the backbone of 2G and 3G cellular standards, laying the groundwork for a licensing model that remains one of the most profitable intellectual property engines in corporate history. The company operates under a split structural framework. Qualcomm Incorporated handles the licensing arm, known as QTL, which owns the essential patent portfolio for 4G, 5G, and wireless networking communications. Meanwhile, its subsidiary, Qualcomm Technologies, manages engineering, research and development, and the massive QCT semiconductor unit. The QCT side manufactures the iconic Snapdragon processor family powering premium Android smartphones, connected vehicles, personal computers, and IoT edge devices. Historically, this dual model allowed Qualcomm to capture money on both sides of the mobile ecosystem, selling the physical chipsets through QCT while collecting patent royalties on virtually every cellular device sold worldwide, regardless of whether that device used a Qualcomm processor. This incredible cash generation allowed Qualcomm to fund immense research and development budgets year after year. However, it also made the business heavily reliant on global smartphone shipment volumes. Over the last 5 years, whenever global smartphone upgrades slowed down, Qualcomm's valuation multiples contracted alongside them. Past earnings reports repeatedly reflected this cyclical reality. When Chinese phone manufacturers over-ordered component inventory, Qualcomm would enjoy explosive growth quarters, only to face sharp pullbacks when those same manufacturers had to pause buying to digest excess stock. The market conditioned itself to view Qualcomm as nothing more than a proxy for mobile hardware upgrade cycles. That old narrative is exactly why current price action looks so disconnected from the emerging fundamental reality. Investors who perform thorough online investing analysis recognize that Qualcomm's entire operational footprint is undergoing a profound structural shift. Management is intentionally reducing its reliance on handset sales by deploying its custom NVIDIA-designed CPU architecture across high-performance laptops, automotive cockpits, and edge AI applications. In fact, during their recent investor communications, executive leadership explicitly laid out an aggressive long-term trajectory targeting over $15 billion in data center silicon revenue and $24 billion from combined automotive and IoT channels by fiscal 2029. The market is reacting to a temporary drop in Apple modem orders, a transition Wall Street has known about for years, while completely ignoring that non-handset operations are expanding at nearly 30% annually. When analyzing a position like Qualcomm stock within an individual brokerage account, self-directed investors often struggle to separate short-term noise from long-term value drivers. Look at how modern self-investing tools handle market swings. Whether an investor utilizes automated rebalancing through SoFi robo-advisor algorithms, manages diversified funds inside Fidelity IRAs, or trades active positions using the Robinhood stock trading interface, sharp earnings pullbacks test investor discipline. The current price drop offers a textbook example of expectation versus reality. The short-term expectation was a flawless quarter, with expanding gross margins across all segments. The reality was a minor earnings per share miss driven by short-term supply chain expenses, offset by robust top-line beats and record-breaking automotive expansion. Looking forward into upcoming quarters, several concrete catalysts and clear risks will dictate where Qualcomm stock moves next. On the risk side, near-term gross margin softness will persist until the double-digit price increases implemented across component lines take full effect in active customer contracts. Furthermore, handset revenue from legacy customers